Thanks, Melanie, for that introduction. So friends, we all know that India is one of the fastest growing economy, right? We are currently the fourth largest economy in the world. But there is whole lot of world which is growing faster than India. So let's take example of South Korea. KOSPI has given over 100% return in the last 1 year. If we look at Japan's Nikkei and Brazil's Bovespa, they both have delivered more than 40% return in the last 1 year. On the other hand, our Nifty has delivered minus 4% return. So clearly there has been lot of happening outside India. And a data released by RBI, which is on LRS, which is the money that goes out of India, it has increased by 25x in 10 years. So clearly that there has been a lot of traction in this global investing. So to decode global investing, today we have created this amazing panel. So I would request you to give a huge round of applause to this wonderful panel. Thank you. Welcome all. So Ankit, I'll start my panel with you. So you know that India is fastest growing story and our Modi ji is putting a lot of effort to make it happen. In such a scenario, why do you think that we should look outside India and not support Modi ji?
So I asked the same question to Mr. Nilesha last week when we had a podcast.
Okay.
And he made it amply clear that it should not be guided by patriotism only. When it comes to money, you should be completely rational and any emotion, including patriotism, should not come there. Now, having said that, there can be a number of reasons for you investing outside. Geographical diversification is one. Currency diversification is another one. Expenses hedging is another one. If my kids are going to study in Europe or US, I should have, I should have exposure in dollar and euro also. And like the gentleman just before this session showed that if you have diversification across geographies, is substantially decrease your volatility also. So many times I say कि more than return managers, we are risk managers. We have to manage risk. And it's always about capping your downside also. So I think these are some of the reasons because of which you should think outside India as well. Now, having said that, I think it should not be outside India, whatever it is. Just to quote you some number, I'm not sure how many of you would be aware. Can anybody over here guess last 25-year returns of Chinese market?
8%.
It's lower single digit. I think 1 or 2%. Last we checked in November, it was 1.5% CAGR, even after the runaway rally that they had last year. So it should come with a word of caution. It should not be कि हाँ मुझे इंडिया के बाहर इन्वेस्ट करना है तो मैं कहीं भी कर दूंगा. You should have a top-down approach and you should see which all geographies and which all markets and which all sectors you should take exposure to.
Very interesting analysis, Ankit. Ashish, I'm coming to you. So when we think about global investing, we always think about ETFs, we think about stocks, we think about mutual fund. But your company offers global real estate investment. So can you take us through this offering? How does this work and what are the opportunities?
Yeah, sure. See, one thing is for sure that the world has become very dynamic in terms of the events which could hamper either the market or our personal lives. Now, given the situation that this dynamism is going to continue, what is it that we should do to look at enhancing our returns? Migration has become the key word today. It's migration not only about people moving from, villages to cities or people moving from one country to the other countries. There is migration of manufacturing here. So we have seen China, then China plus one, then China plus two. We have seen tremendous progress being made on the manufacturing side, in India. So when you have manufacturing coming, you have requirement for the factories, you have requirement for the warehouses. 10 years back, e-commerce was not really a word what, we could understand. Today, every, door, you can see a package arriving every second day. That has created requirement for the warehouses, in the country or in the city. When we talk about the IT revolution, new concept coming in, AI has become the buzzword. Pramod presentation spoke about, the data center, which is, requirement for the power and the water. Again, we have a new asset class, which is the data center. Now, if you see the common footprint across each of these asset classes, real estate is the constant theme. So, but many of these themes, how do you really play into India? You don't have, data center play in India. You don't have data center REITs in India.
Oh.
The best performing REITs in the US is self-storage, which has delivered 17% return for last 25 years. If we compare the size of REIT in India versus to a city-state like Singapore, we are no comparison, nowhere. Our REIT size is about $20 billion market cap. A small city like Singapore has a REIT size of about $100 billion. And if you see the returns, what they have delivered over last 20 years, see, REIT has a history in US. It was first introduced in 1960.
Oh.
Today, the REIT capitalization in the US alone is about $3.5 trillion. So now many of these asset classes, you don't have a footprint in India. How do you really want to play it? As Ankit said, diversification for the sake of it is not really needed. But if there are very strong themes, as an investor, you don't want to take a very emotional decision. You really want to invest where you can maximize your returns. Now, how do you maximize? We were speaking about, Dubai market, what has happened in last, 3 months. But before that, last 6 years, many of the market have delivered 2x, 2.5x returns. Commercial occupancy in India is about 93-94%. Commercial building occupancy in Dubai is about 98%. So, do you really want to miss out on those opportunities which are there? And if you really want to play, then how do you play is the second question. LRS limits have increased, to $2.5 lakh. That becomes an obvious way for you to play those markets. But currency diversification, geography diversification, mega themes, still you will not find a play in Indian market. So, for example, US is delivering about 6% yield. You add another 3 to 4% of the currency depreciation, you are sitting on a pure yield of 10% in dollar terms. So those are the opportunity which one has to see and diversify the portfolio.
Very insightful, Ashish. So, Pramod, I wanted to understand that we are living in a war economy now, right? So, every other country, second country is on the war right now, right? So, but India, I think, is safest of all. If so, we are seeing West Asia war, we have seen Russia-Ukraine war, but India is safest of among all of them. So, why do you think it is the right time to go global?
Yeah, but look, I've already spoken, so at the expense of being a broken record, I'll repeat the same thing. But when it comes to wars and geopolitics, right, I think the period after the Cold War ending in 1990 till about 5 years ago was a very exceptional period in human history. Otherwise, we've always been at war, right? Even preceding 1990, we had in US and Russia in that Cold War. We had 2 wars in the Middle East, the Iraq-Iran war, then you had the Vietnam War, the Korean War. So you go dial back a little bit, the World War II preceding World War I. And throughout human history, we've been fighting with each other. That's not new. Yet, even prior to the Cold War ending, so-called very violent period in human history, the S&P 500 compounded at 10%. Right? 100 years. 100 years, the S&P 500 compounding didn't stop. So while we can all have a very entertaining discussion on whether this war will end or not, we can have our own views, but I think it's futile because there's no point in analyzing irrational president's action because I don't think he himself knows what he's going to do. So who are we to predict his actions? So we can have that over coffee or over a drink. It'll be surely entertaining. We'll all be listening to a lot of podcasts and reading a lot of blogs on geopolitics. None of this matters for investment outcomes. Zero value add from reading geopolitics, pandemics, interest rates, currencies and all that, except for intellectual satisfaction. for protecting our clients' wealth and growing them, I'll go back to asset allocation and diversification. In some ways, asset allocation is meant to address exactly these risks, right? If you are diversified across different economies, including India, global, at any point in time, some or the other economy is erupting, some is cooling off, you will have enough exposure. So therefore, my point is, let's keep this aside for social conversations, for investment decisions. It is as boring as it can get. Diversify, asset allocate, systematically rebalance, which unfortunately is the hardest thing to do from an advisor's perspective. I remember somebody was talking about an RIA in the US who calls himself the CBO of the business. He doesn't call himself the CEO or the CIO. A lot of wealth houses have CIOs because that's the guy who decides investment objectives and so on. He calls himself the CBO. The CBO stands for Chief Behavioral Officer. He says, my only job with my clients is to control their behavior. Stop them from doing stupid things. That's all. And in fact, he's gone one step ahead. For all his relationship managers, he doesn't hire CAs or CFAs or finance grads or MBAs. Guess who he hires? Psychology graduates. Because he thinks इन लोग को financial planning और asset allocation में 2 हफ्ते में सिखा दूंगा. Right? It's very easy. What we do in terms of stock selection, research, all is very easy. As intermediaries and custodians of our clients as well, our only job is to control their behavior. So as psychology graduates, they're trained to control the emotions of their clients. There are techniques which will stop your HNI client from investing in the latest thematic fund, right? Most thematic funds are launched after the theme is run up. So how do you help the client resist that temptation to invest in something that's already run up, or resist the panic after a drawdown is the only value add. So I would say you're not distributors, you're not advisors, you're actually counselors, right? So to that extent, all of us will do well if we take a psychology course, forget about geopolitics, macroeconomics, do the right thing for the client.
Lovely. Saving your portfolio from yourself. So as they say, saving your portfolio from yourself.
Yes, correct. Lovely response, Pramod. So, Rikesh, so I'm convinced by listening to 3 gentlemen, I'm convinced that I want to go global. Now the next step is I wanted to understand that what kind of risk analysis I should do, what should be ideal time frame, and what are the things that I should keep in mind as a wealth manager before recommending these products.
Okay, so I'll just go back a little bit. The mutual fund industry is about over 3 decades old. And there was always this inherent pattern where people wanted to invest in international stocks because they read about it in the news or saw about, in the papers. And there was no avenue actually. I think we've made baby steps on it, very, very small. Today we have a ceiling of $7 billion, but it's been a very small and slow journey there. And in terms of risk, I remember I was seeing a fact sheet of Credit Suisse or UBS, and this was all the way back about 15 years ago. And that fact sheet was, I think, this thick, because not only did they have every different category of fund within their own country, but they also had smaller feeder funds across the globe. And, the West has been very active in managing wealth, internationally and not only domestically within their domicile countries. I think that has seeped into our country through the feeder fund route, and now, of course, has been expanding through Gift City. But then coming down to risk, right? The fundamental question is that if you were to invest, what do you know about these companies or these investments? The only thing you would see is probably Google the returns and just see how the markets are doing, or you would get enamored by the names of the company. Like if you're looking at a European fund, you look at a Santander Bank, or you look at Mercedes-Benz, any of the listed companies. So it's always a story where you need to know more, right? Because in India, we are heavily researched by various today, if take a mutual fund, you have a CIO, you have a fund manager, you have a research team, and you have many reports coming in from brokerage houses. So when you actually put your money in any international fund, how do you know what you're investing in? What the parameters are of those funds, right? So that becomes imperative. So when a mutual fund comes to you today, you need to have those statistics, right? I think I urge mutual funds to put up a small, maybe a cumulative desk, because cost becomes a issue, so that these companies can be tracked when they are opening this avenue of feeder funds, to understand what people are investing in, and not just looking at like FANG stocks through a Parak fund, because that's the notion people have. The second part I'd like to talk about from a risk point of view is, right now, I'm not even going into GIFT, I'm only going into feeder funds. There is no form of any currency hedge. Being an ex-banker, when I was last with one of the prominent banks, we had sold a fund of a fund house, one of the first funds, principal emerging market funds, all the way back in 2006-7, right? And we sold it because of a differential between the Indian market, the PE differential between the Indian markets and the emerging markets. The Indian markets were very expensive, the emerging markets were looking cheap, right? Now, people were very, very happy to invest. The people who understood that took the leap of faith and did invest. But over, I think, the next I think just before the Lehman crisis and everything went wrong, currency spiral, came down, and people actually, whatever return they had made, they lost all of that because of the currency, right? The appreciation, actually, the depreciation internationally and the appreciation of the rupee, right? All those returns were gone. So I think the three most important risk parameters today is how to hedge the currency, right, which is not inherent in feeder funds as yet. The second is to understand expense ratios, right? The fact sheets of all Indian mutual funds have a expense ratio that you can see both on direct and regular. On the feeder fund, on the fund of fund route, how do you understand what the expenses are, right? There are different classes and categories of shares internationally that you invest in. And the third, of course, is the research itself. So these are the 2 or 3 main risk parameters that I would try to understand before investing. But again, looking at the larger scheme of things, you would cap your investments to a percentage of your portfolio, because it's not that when you speak to your advisor, you speak to me, or you speak to your relationship managers, that they are going to be able to tell you all that data, right? So you have to have a cap. What you would like to look at is not the exotic investments that you're making in these companies, but that you're investing as a hedge to your current investments, as well as looking out for growth in other economies, other companies, as a diversification to your portfolio.
Very insightful, Rikesh. So now it's time to play a small game. So I'll be acting as an investor and you will be my wealth managers. So I'm coming to you one by one, starting with Ankit again. So Ankit, I've heard that global investing comes with currency risk and complicated taxation. In fact, in the last 5 years, in dollar terms, we have not given any significant return. Then why should I complicate my life by investing overseas?
Great. So thankfully, currency risk is on positive side, because when you invest in currencies like dollar, where the underlying is dollar, not the wrapping of the product is dollar, you gain 3-4%, 2-4% per year on a long-term basis. So now it can be stair side also. Stair side means ki it goes up 1 year and then it stays stabilized. But on long-term basis, 3-4% you make on currency side. Now coming on the taxation side, there had been a lot of ambiguity on the same for a very long time. But after recent budgets, I think there is strong clarity. If you go through managed funds like Gift City or fund of funds in India, that it will be after 2 years 12.5%, before 2 years it will be added to your income. And of course, everybody will appreciate that nobody invests for less than 2 years in equities, logically speaking. So I think on taxation side, there is enough clarity now. So except for longer holding period as compared to 1 year in Indian equities, it's same. And what was the taxation and currency? Currency, of course, it's positive only for as an Indian. In fact, if you talk about documentation side, investing outside India has become more easier than investing in India only. If you look at KYC, etc., I think Pramod covered on that part. Sitting over here, you can do everything online. Even if you are a Dubai-based NRI, America-based NRI, everything can be done online. So I think logistically speaking, taxation and everything, it's quite easier as compared to earlier times.
Great. Ankit, so where does real estate real estate products fit into my portfolio?
No, I don't think it is a question of fitting something into your portfolio. We have to look at very dispassionately in terms of which asset class is going to maximize my return. The allocation is a subject matter of individual choices. Some may be heavily towards real estate, some may be not so heavily towards the real estate. So I think it's a matter of spotting opportunities in the market, and that allocation could be dynamic in terms of where you see opportunity either in the course of the Indian market or in terms of what's happening in the overseas market. But see, one thing we have to keep in mind that every country's balance sheet is an indication of country's mind, and a strong balance sheet takes years to build. We have seen smaller country like Singapore or Hong Kong, what they have done with their economy. And similarly, it applies to, smaller country like Dubai. So something which is inherently strong will not, get destroyed in, with one or two event. And so we have to discount those events and look at what's going to be the long-term opportunities. In my personal view, the biggest or one of the biggest beneficiary of the growth of India could be the nearshore market like Dubai. And we have seen the indication of what's happening in those market. And I will not be greatly surprised that lot of businesses in India, in time to come will be handled or managed from Dubai. So the city offers something which probably at the moment India may not be offering, whether it is in terms of the security or the quality of life or maybe to some extent quality of education. So that does really plays a very important role when people are looking where they want to be located. And, at least that's what I could see, that as country progresses, as we grow, a big chunk of those wealth being created will also flow to market like Dubai. We are already seeing that the biggest population buying Dubai real estate is Indian. Almost 25% stock is being bought by the Indians. And that percent is not going to go down. So we have to look at how the things are changing, which market are easier, which market we can study well, and then accordingly take the decision on the allocation.
Great. So Pramod, the global investing also comes with lot of hidden charges. So we have forex charges, we have transaction charges, and in some cases I've heard these charges go up to 3%. So do you think it make economic sense to do global investing in such a scenario?
Well, hidden charges apply if you don't want to do some research and figure that out. Having said that, I think the forex charges have reduced over time as more and more Indians are sending money abroad. If you compare it with, say, 10 years ago, the spread you would get on a foreign exchange with even some of the largest banks has come off dramatically. Add to it, in GIFT City, there are something called payment service providers or PSPs. This is a separate category of regulation. They do pooled forex with tie-ups with banks, and hence they're able to give you better spreads. Net, forex is no longer a concern in terms of a spread, and more importantly, it's a one-time effect, right? It's not an annuity, and presumably, irrespective of which asset class you decide to invest in, you will hold on to it for 3, 4, 5 years or until the time that money is needed. And if the idea is to utilize those funds abroad, it remains one time. It's not like you're bringing it back to India. For example, you make the investment to fund a kid's education. You have to keep it in the currency. Transaction charges, then look, it's no different from any other investment you make. You need to do your homework. You need to figure out for your clients what are these charges and so on. I don't think GIFT City products or global products are any different. If at all, if you buy ETFs, remember in the US today, there are more ETFs listed on the American Stock Exchange than stocks. You can actually buy very diversified portfolio of funds at a fraction of the cost. A few years ago, Fidelity sort of shook everything by launching an ETF at zero cost. They're almost running a charity of sorts. But suffice to say, most ETFs have very low expense ratios. In case you have a managed account on interactive brokers for your clients, you can buy these ETFs as next to nothing. The brokerage is also fairly simple. So it's a little bit of a myth that there are hidden charges. Of course, there are providers who will try their best to hide these charges and sell stuff to you, which is no different in India as well. We've all been familiar with some of these. So I think we'll need to keep that aside and look at what is the ultimate objective of your investment. Most of that objective will more than overcome any sort of charges which might be higher on the initial side.
Nice. So Rikesh, I've heard about products like inverse ETF, crypto ETF, AI-based ETF. So are these products are they really adding value to clients' portfolio, or are they just a hype?
They're making money, all right? The point is anything that makes money makes people happy, and so they're good for the clients, perceptionally. But when we talk in the Indian context, and I'm taking back from what you asked me last, again, investing in, fancy stocks or putting money in crypto is more of a hype, right? Because what is the depth of knowledge that people have on these products, right? So I would say that at least in the Indian context, right, globally they may be really, really big, whether it's an inverse ETF or a crypto ETF or an AI ETF. But I think for India, the basic fundamentals of investing internationally is something that should drip down to every retail investor. Right now, investing internationally is a very niche market, only for the high net worth set of customers, in spite of having a fund of fund where you can put 5,000 rupees in a Chinese fund or a European fund or a US tech fund. But like I said, the depth, people need to acquire knowledge on what they're investing in, right? Today, we are very well defined in India between, large cap, mid cap, small cap by SEBI's market capitalization definition. But when there are many times when you speak to fund managers, you speak to research analysts, there is so much more depth to what you understand. I'm not saying that research is available to everyone, but I'm saying a basic level of understanding is what people should have before even looking at these products. I think Mirai had one AI ETF, index fund or ETF, which they launched, and I think there was a very small window of investment and they shut it down. But that ETF has gone up substantially. I think it's one of the best performing ETFs in the market for the AI thing. So I think more importantly is people should first start reading, first start understanding what they're investing in, right? Investments is it appears to be a very exotic business. It's very easy to put money into an investable product, but how to manage it and when to exit is also a question. Another part to your question.
That's it. Yeah. Great.
Thank you.
Yeah. Ankit, so I wanted to understand that there are a lot of global products currently. We have ETF, we have funds, we have direct equity. So how can, as a wealth manager, I can evaluate the quality of these products, and how can I shortlist what is best for my clients?
So let me first share a story which shows the best way you can do it, at least in short term. There is a friend of mine who is counting on a daily basis how many missiles US has fired, how many missiles UAE has intercepted, and how many have landed, blah, blah, blah.
Oh.
Why is he doing that? Anybody can guess over here? Because he is invested in American defense companies. So that was one way to answer your question, that he took a thematic call and he invested in those companies, and now he's assumingly making more money. But let me, so if any client would ask me this question, how I would reply to him, think about your investment journey in India. How you started your investments in India. What were the good things that you learned on the way? What were the bad things that you learned on the way? And then implement them. If I have to do it for myself, I'll go top-down approach only, but there will be an added layer of on the top, that is geography. That I'll first decide which is the geography I want to invest in, what are the sectors or what are the themes or what are the ETFs or what kind of funds I want to invest into, and then I'll obviously go to the dharma of investment, which is asset allocation.
Great. So Ashish, so you have highlighted what are the opportunities in real estate, but what are the risks in real estate investing?
So I think risk is inherent in any investment that we make. Uh, it is our job to understand where exactly we are putting money in. My fundamental premise is that life में lottery किसी की लगती नहीं है. So, we are the best guardian of our own money. Your advisor will come, will advise you, but it is very important, pertinent for us to understand the logic behind something being proposed to us, and also go back and do our own homework in terms of the themes being spoken to us about. So I think, there is no substitute to hard work, homework when we look at taking any investment decision. And ultimately then, it is our own trust and belief in our thinking, which has to be, important when we want to say yes or no to an investment theme. So I think inherent theme will always be there. You may always go right or you will always go wrong, because things may not span out the way you are looking at it. But I think a broad fundamental understanding should be there in terms of, what we are doing and where we are investing.
So what are the risk mitigation strategies that you apply?
No, I think diversification is very important. As I said, you look at country, see, whenever there is a crisis, it is not like the wealth allocation is getting disappeared. It's not like people are suddenly sitting on loads of cash. The money moves towards market which are stable, which are strong, which can go through the crisis in a much better way compared to the weak economies. And that's where the wealth moves. We have, in last, 1.5 months of the, the war which is happening, lot of inquiries have come to us not questioning whether we should be investing in Dubai or no. All they are asking is कि दुबई में भाव कम हुआ है क्या, अपॉर्चुनिटी खड़ी हो रही है क्या. So people have not suddenly turned negative about certain market. That's what we said. Just Dubai is one market. There were no LRS 20 years back. People have devised their ways to invest across the market. UK has been the favorite hunting ground for the rich and famous from, either north or from Bombay, and people have made tons of money in those markets. They were ahead of the market. So I think those trends are important to recognize. But as I said, country's balance sheet, the way country behaves, the way they have built their DNA is very, very important to figure out, how the country is going to be next 10 years. So I think we have to, don't get, swayed by the short-term trend. Look at the long-term trend, and that will, help us to diversify and control our risk.
Great.
Ishant, I have an interjection over here to make, if you would allow me. So one point that almost all of us miss is regulatory environment of the country. So in good old days when we used to have ease of doing business ranking by UN, can anybody over here guess the rank of India over there in one parameter, which was safeguarding the interest of minority shareholders? Any wild guess?
157.
Well, the ranking was only 5. Only 5. This is how good SEBI has worked in India, and we all should be proud of this ranking because it shows that our public institutes are very strong. So what Mr. Joshi was trying to say is that you should look at country holistically in their balance sheet, their fiscal deficit, their trade deficit and other macros also. But I think in addition to that, you should also look at regulatory environment, how predictable it is, how pro-investor it is, and how fair it is.
Great. I must add here, I had a live example of the Singapore market. We talk about ease of doing business. Whoever goes to Singapore, buys something, even if it is from a roadside shop, they will insist issuing you a receipt, which will have the VAT, what you have paid. It has taken me precisely 3 minutes to get my VAT refund in cash at Singapore airport. That is what the ease of doing business is in those markets.
Great.
Yeah, given everybody is adding, I will also add. No, I think we all complain that India's corporate governance is bad and so on. Having looked at other emerging markets, I'll have to reassure you, we're amongst the best. Forget about other emerging markets. Even a market like Japan, which is known to be a developed market, is known for atrocious corporate governance when it comes to protecting minority investor rights. It's only when the late Shinzo Abe, about 4 or 5 years ago, brought in some reforms on corporate governance, did the great Warren Buffett finally decide to invest in Japan. The first time he got investing in Japan was 2022, after he got comfort that the governance changes have come in. Nishan talked about Korea doubling over the last 1 year. Why do you think it has doubled? The current Prime Minister who came to power a year ago, there's a little bit tidbit. He used to be a day trader before becoming a politician. So he's had live experience of being shafted by managements of listed companies. And he brought in significant reforms in terms of protection of minority investors, right? Japan, Korea are not small countries. These are fairly advanced countries, and they have governance frameworks far weaker than India, right? Which is why in our global portfolio, we've decided to invest predominantly in the developed markets. We invest in US, Canada, and Western Europe. Not because we don't like the growth in emerging markets, but there are global businesses available in developed markets which also dominate emerging markets. For example, Microsoft, right? Microsoft would perhaps be India's largest tech company. If it was listed, Microsoft India's business was listed, it would perhaps be bigger than TCS and Infosys. Similarly, Apple is listed in America, but half its production happens in China. Half the iPhone sales happen in China. Or a French luxury hat maker like Hermes, biggest luxury sales happen in China. So you can play emerging markets through companies listed in the developed world without taking emerging market corporate governance risks. So that's my 2 cents. The regulatory environment is particularly important.
Simply put, we need a fund manager to become a PM. Great. So, Pramod, I wanted to understand that many people equate global investing with US investing. But there is a whole lot of world which is beyond US. Then how can distributors decide country-specific allocation? And how do they come to know that this country will do well in future?
No, you don't. I don't. I don't think anybody does. In hindsight, we can all say this was the greatest time to invest in the US, this was bad, and so on. Remember, I gave you the statistic about NASDAQ returns in the last 15 years, right? 22% in rupee terms, phenomenal. The decade prior to that, from the peak of the dot-com boom, for 10 years, NASDAQ returns were zero. So if you asked anybody what will be the return sitting in 2010 or 2011 over the next 15 years, I don't think any of us would have thought NASDAQ will deliver 22%. The short answer is nobody knows. But does that mean that we're all at sea, don't know where to invest? No. I think it was Somnath who mentioned, the easiest way to start is buy a global ETF. The index which covers all country world index is called ACWI, ACWI, MSCI. There are plenty of ETFs which are tracking this. Now, unfortunately, like somebody mentioned, global market cap is roughly about $105 trillion, of which US is $65 trillion. So even if you buy an ACWI, you will get 65% access to the US. But the reason US being a $30 trillion economy on a $100 trillion global economy, which is just 30%, yet 65% of global market cap, is the US has been very prolific in terms of generating long-term wealth creators. So irrespective of diversification, you will end up having a US skew. Having said that, don't just rush in to buy an S&P 500. I would say find a global ETF. We're shortly in the process of coming up with our own global multi-asset product. As many of you have appreciated the benefit of multi-asset funds domestically, even globally, I would recommend diversified multi-asset products where you not only get exposure to US equities, emerging market equities, but also US bonds, emerging market bonds, commodities, real estate, and so on. So diversify across asset classes, diversify across countries. No country is going to give you returns consistently.
So Rikesh, what are some common mistakes that investors make when investing globally?
In the sake of time, I'll just keep this very short. I already mentioned in my last comments that people don't look at the finer points of where they're investing, especially when it's globally, right? And I think so-called exotic investing, right, into companies that you read about, like For example, if you own a European fund and you own LVMH, right, you feel very happy, or you own a Rolls Royce, right? But how many people know Rolls Royce makes, aircraft engines better than they make cars? So the understanding of what people are investing in is very important. And also, it's very, very important to understand, and I'm very happy to see where India is today in the global context of things. So I'm hoping that the Indian currency does become stronger than the US dollar, which I'm hoping, and that for that reason, investing globally also becomes a reason to a reason to understand how to hedge your investments there from a currency risk also.
Okay.
So according to me, these are the two main things to understand before you write out a check into any global mutual fund or AIFs going forward.
Great. So before, so time is up. But we'll play a small game, rapid fire, to wind it up. So starting with Ankit. So one country other than India, investors should explore.
So I should just mention the country name or the...
Yeah, country name and reason.
Of course, it has to be USA only. So reason I would tell you, so if you look geography-wise, let's go continent by continent. Africa, I won't be comfortable investing into. Europe, I think, is very aging population, no migration inwards, etc., etc. Then in Asia, you will have Middle East. Middle East doesn't have very deep listed markets. China, I don't like because of many reasons. So only market that is left, major market, is US or other emerging markets. Now, problem with emerging markets is, I don't know how many of you would know, but if you discount last 5 years, the best performing emerging market, one of the best performing emerging markets was Pakistan. Recently, Microsoft exited from Pakistan. So I won't be like to be part of this kind of story कि जहाँ पे 10 साल एकदम से रिटर्न आया फिर पता चलता है कि Microsoft ही exit हो गया वहाँ से. And most of the countries which are branded, clubbed with India in emerging market bucket comes under such kind of ideas only. So emerging market mein I will always be pro-India, but for developed markets I will go for US. I would like to have exposure to defense, AI, deep tech. As Pramod rightly said, I would like to have exposure to Google, Microsoft, etc. because I am taking a call on the global IT story. So to answer short, US only.
So Ashish, what kind of rental yield and capital appreciation I will get from real estate investment?
So for different market, it could be different. But if you look at the nearshore market like Dubai, you get about 6 to 8% yield and about say 10% appreciation. Look at the US market, which is by far the biggest market. And, in the dollar terms, your returns could be upwards of 11%.
Great. So Pramod, one skill development that MFDs need to develop before recommending global products.
Well, you can call us, but yeah, I think the answer is the same, boring. Appreciate the powers of diversification and asset allocation. The rest of it will simply follow. I can give you a list of blogs to read or podcasts to listen, but nothing like, committing to diversification and asset allocation.
So Rikesh, I have saved the best for you. If you were a finance minister for a day, what change you will bring to make global investing simpler?
Interesting question. Today, when we talk about exports and imports, our imports into India are roughly around 24% in US dollar terms of our GDP. Okay. Our mutual fund industry is between 17-18% of in GDP terms, because we are already close to, I think, 80 lakh crores, right? 90 lakh crores. But our global investment, leave aside gift, through the fund of fund route, is capped at $7 billion, right? And that is, I was doing some research, it's only 0.17% of our imports into India as a percentage of GDP, right? I think that limit definitely needs to be expanded to allow the industry to grow, all right? Because, when we talk about gift today, it's a more evolved product, right? I mean, it's, understanding LRS coming into gift, right? But the easiest is and the safest is yet coming through the mutual fund route. You have a trusteeship, you have a whole great management in a mutual fund company. So why not just expand that horizon? And there are so many great products that are available globally. All you need to do is, even if you make that 1% today, there will be a flood of investors coming in wanting to invest. So I think the investment limit should be increased. Investor education in that segment should be increased. And I think, we will all, and anyways, there is so much information dissemination, right, today available through various streams of technology. And with the new generation coming, I think we need to capitalize on that opportunity.
All right, we have come to an end to this interesting discussion. Thank you so much. You have given a lot of insights and food for thought. A huge round of applause for this. Thank you so much.